Assalamualaikum and hello everyone. Welcome back to the second part of the videos on the preparation of statement of cash flows using indirect method, where we are using the 6 steps color coded approach, and this is the second part of the video for a company called CashisKing Bhd. Right. So we have already done the first part, which is to calculate the cash and cash equivalent, where I use the bottom up approach, that I have already settled the part on cash and cash equivalent up till the cash flows from financing activities. So this second presentation is going to continue using or doing the preparation of cash flows for to determine the cash flows from investing activities and later for cash flows from operating activities. So let's look at what are investing activities, and I've already color coded them earlier. You can check that also in my previous video. So my color code for my investing activities is blue. So let's look at the first item here, which is freehold land. So if you can see the freehold land, the item here, there was an increase or a decrease. You need to check. So there was a decrease because beginning balance was 3220 and at the end it becomes 2.910 million. So there was a decrease or a net change of 310,000. So as I said, every time you do your analysis here, make sure that you checked for those items that you have already reviewed so that you won't miss anything, right? So freehold land, it seems like there was a decrease. So you need to go and check whether that was due to derecognition of the freehold land. So if there is a derecognition or disposal, meaning that maybe that was the reason, but you need to also check if that also relates to any profit or loss, if it is really a disposal. So to check that, you have the bottom item at the bottom here, number 5 that I'm highlighting. I'm using the same color, which is blue, right? And you are informed that it was derecognized at a profit of 130,000. For your information, the profit of 130,000, right? The profit here is a non-cash item, meaning to say that the profit is actually a non-cash item. However, I'm going to highlight that in red so that it becomes better. 130,000. Okay, this one should be included as your adjustment for non-cash and non-operating items, because remember we are doing this for our indirect method, but at the moment the profit was 130,000. So what we can do is we can now set up the freehold land account to see what is actually the cash receipts from the disposal. So let's do that. What you need to do is you need to take this balance, which is on the opening column, put this as the beginning balance of your T account that you will reconstruct, and this one will be your closing balance, and later the profit figure will have to be included as well, because we are now trying to show that the disposal or derecognition is at a profit. However, there is no depreciation for freehold land because freehold land is a non-depreciable item. So how do you do that? Right? I've done this for you. First, put the balance, put the opening balance. Okay, you can put the opening balance. Okay, and then you put your closing balance. Remember, I took them where from? I took it from my statement of financial position. Okay, and then there was a profit. When there is a profit, the simple journal that we can do is, or simple accounting entries is, because profit is the item that will be credited to the profit or loss account. So this profit of how much? It is given just now, the profit to be 130,000. So that is a profit or gain on disposal, 130,000. Say there was no disposal that give any depreciation here because this is a non-depreciable asset. Should there be any depreciation, maybe you need to go and have another item here as your depreciation, somewhere in your accounts here. But this in this section, there are no such thing as land to be depreciated in case this is about a building or maybe your plant and machinery, and that is at carrying value. Now you can get your balancing figure. How? Total up this section, total up. Yeah, if you total up, you get that figure, and that total is the same here. And the figure here will be the one that you are looking for, which is the proceed from the disposal of the freehold land. By taking 3.35 million minus 2.91 million, you have 440,000, and this is actually an inflow. Yeah, inflow. Inflow means you are going to go and add them in your investing activities, and you're going to put here proceed from disposal of freehold building. Now we have done that. Yep. You have another item that you need to do. As I said, we're going to do this concurrently with our adjustment item here. For your information, we are going to start off with profit before tax. But before that, we are going to look at adjustment for non-cash transaction. So profit or gain on disposal of long-term investment are the things that you... Wait, yeah, I'm going to just put this like this. Okay, this is our first item that we have obtained. Just highlight that first. Okay, I'm just highlighting profit on disposal of freehold land, 180,000. Whatever items that previously you add to arrive at the profit before tax, now you need to do the reverse, which is you are going to go and deduct or go and take it out or remove from the profit before tax, because this is cash item or non-cash income. This is non-cash income, right? So you will remove that profit, right? The second one is looking at, there are no depreciation for you to remove because this is non-depreciable item. Next, for you are done with that, right? Now we go to the next item. Your next item would be I'm going to choose a simple one first, which is I'm going to use my item that is not depreciated, and that is the long-term investment. So long-term investment is not cash and cash equivalent. These are non-current assets, so that you can see that there was a decrease there from 90 down to 80,000. So there was a decrease, and maybe these are due to also a disposal, but you need to go and check if there is any disposal. You have this to confirm that analysis that you made, which is it was being disposed at 110. So the figure 110,000 straight away give you what are the cash flow or the cash receipts from the disposal. So therefore you can straight away take the figure and include it here. Proceed from long-term investment. It means that you debit your bank account, you credit your long-term investment. And because you credit your long-term investment, you debit your bank, that is an inflow, right? You can do that. But you need to also do another thing, which cannot simply by putting this here, because it might also relates to some profit or loss on the disposal. Because profit or loss is actually an item that you need to go and adjust here, non-cash transaction. So what you can do is you can set up your investment account. Put the balance at the beginning, right? Put the balance at the end. Put the proceed that you receive, yeah? Debit bank, you are given that in the additional information just now, right? 110. And again, this is your inflow under your investing activities. And this is the total. Sorry. This is your total. And your total would be, okay, I have to go and calculate them. 110, 120. This side should also be 120, right? And the figure that is missing here is actually going to be your gain on disposal. This figure didn't gain on disposal. The effect is the same as for freehold land. You're going to go and deduct in your item here, because earlier you have added to arrive at the profit before tax. So this one I have color coded that as turquoise to differentiate between non-cash transaction. Right, non-cash transaction. Right, so these are the thing that you should include it. However, if you have come across a loss on disposal, do it the reverse way, meaning that you need to go and add back. Right. For the freehold land and investment, there are no depreciation. So we are done with that. We can go to our next item. Okay, you can now go on to your two items, which is plant and machinery, where you can see there was an increase of 290,000. So we're going to investigate that and going to go and review thoroughly what caused the changes. So go and check additional information if there are any information telling you about what happened to the changes in the plant and machinery. Yeah, you have one item here. It says that there are no changes that were due to disposal. So meaning to say that if there are no changes that were due to disposal, the changes is solely due to the purchase being made, because no information stated other than just about no disposal. So there is a change of 290,000. So this is due to purchase of more PPE during the year. So this figure 290,000, you can copy and paste them to your cash flow from investing activities here. Yeah, 290,000, it will be an outflow. Or you can also, if you want to see how good is your debit credit skill, you can put the balance here. You can do this, but you don't have to do things. If you can get that faster using the looking at the changes, right? I would suggest you can skip this unless you really want to learn, and why not you just do it, right? So here there are no disposal. How? Because it was informed, right? So this is just to help you with your understanding of the T accounts or the debit and credit, right? And for this item, yeah, you are to include them under investing activities, and it was an outflow. So this is an outflow. Why outflow? Because this relates to investing activities where you purchase and you credit your bank account. Outflow. And this one is inflow. Inflow. Those are all blue, right? And then next is to look at the effect for that on depreciation. Because when you have accounts at cost, it is also being depreciated, right? So we are done with this. We now go and check your accumulated depreciation account here to see whether there is a depreciation. Yes, there is a depreciation being charged for both accounts. And you can see that the changes here is 40,000. There are no disposal, so you do not need to adjust for any disposal adjustment for the depreciation. So 40,000 is your depreciation from your plant and machinery. So you can straight away include it here. You can put it here. And you can color code that as turquoise, 40,000. So depreciation was earlier being deducted. Now you will add back because depreciation is a non-cash transaction. Next. So if you want to see the effect in the T account, I will just show you the effect here of the T account for the depreciation. And these are all in this color. Turquoise, to show you these are all nothing to do with cash flow movement. It is just an item related to the non-cash transaction. Right. So we have done that and put inside our cash flow statement under our operating activities. As I say, as you get the answer for your investing, you can also get your answer for your adjustment for non-cash transaction and non-operating items under your operating activities. You can do that concurrently, because if you keep on delaying it, you might tend to forget it at all. right? Next one is the last item under investing activities that we need to investigate, which is our two items here. One is our changes that is due for our motor vehicle. Another one is for our accumulated depreciation related to motor vehicle. Here you can see there was an increase of 623,000. Why? Beginning was 960, at the end 1.583 million. Now the increase was 623,000. So to go and check the information, always check information that is given in case there are things that could help. So there are none here, nothing. So we can make some conclusion or some assumption, which is safe enough, that the motor vehicle was being purchased during the year for 623,000, because there are no other information unless you have the data that the company may have given you that confirm you. But at the moment, for this is just a question during session, you can assume that to be increased because of the cash flow that you pay to acquire your motor vehicle. So you can include that purchase or acquisition of motor vehicle here, and that would be an outflow. Okay, now you can have your total up this 4 item here, and the total will be 363. And don't forget the item just now for the depreciation, the same thing that you did for your plant and machinery, you should also do the same checking here. Yeah, 420 increased to 510. The difference is 90,000 that was due to depreciation, the changes, and that depreciation should be added back to your adjustment item, because they are non-cash transaction. That was just by using the changes column here. However, you can also do it by opening up the accumulated depreciation account for your motor vehicle. This is just for revision and also to strengthen your debit credit skill, your double entry skill, yeah, and it would help you with your preparation of financial statement, like your statement of financial position as well as statement of profit or loss. This is our investing activities, and we are actually looking at this part, which is our outflow again. So this is another outflow, right? Okay, then next we put the depreciation back to the item here, right? And we are done for our investing activities. You can see here most of the things we are done. We need to go and check now our transaction that relates to item which are at the bottom here. So let us look at the item that relates to our operating profit before working capital changes. I will leave the profit before tax to be the last item to do, right? Operating profit before working capital changes, just look at those colors that I have not yet even investigated, which is accounts payable, yeah, inventories, account receivable, revenue receivable, your prepayments, and also those that will appear here right after cash generated from operation, which is going to be your tax payable, tax paid, and debenture interest paid. But let us just do the things for interest for tax paid first. How much is the tax paid? Remember, we are doing bottom up, so we're trying to find out this item first, tax paid. So you are given the tax paid here directly. Yeah, tax paid, it was 200,000. So just include that tax paid here without having to do any workings, unless this is going to be done later, because we also need to find what are the taxation charge as well. But at the moment you have the answer here, but I can also show you the taxation payable, taxation account that I have opened up for you. Okay, you can see here, I zoom for you. your tax charge. So before that, if you check your statement of financial position, there is an opening balance under your tax payable, this one. So that one should be put on the credit side of your taxation working account. And there's another one, tax recoverable. That one should be put on the credit side as the balance carried down. This one put at the credit side as the balance brought down, because this one is an asset, right? So you're going to put this as the as the balance, the closing balance. This is the opening balance. And then the tax paid should be put on the debit side of your account. Okay, we go to that part now. See, where is it? Here it is. Okay, we have the balance here that was taken from the SOCF. This is the one tax recoverable. This is the tax paid from the additional information, and therefore your tax charge would be 60,000. So this tax charge of 60,000 is actually the one that need to be reflected in your retained profit. So you need to go and put that in the retained profit. That is your tax expense. So put the balance for the retained profit as well, beginning balance, and put the ending balance for the retained profit. Put that two balances first and insert your taxation figure first, right? Put the balance. Where do we take this? We take this from our retained profit here. So now we have done this, and we have taken this figure 910 as the closing, 820 as the opening, because we are also trying to find our profit before tax, as we are down already in our operating activities, right? After you have done that, you'll be able to get your taxation expense and include that taxation expense here, because our target is to find the item here, which is profit before tax. Your profit before tax. Okay, I put it a little bit bigger for you. Next, the next item is for the debenture interest. Remember, we need to calculate also things for our loan that we have taken from our customer. Here is not loan but debenture that you issued. So I told you earlier, it was issued on 1st of May. The changes was issued on somewhere on 1st of May. So to calculate the debenture interest, you need to go and calculate it correctly. You are trying to find what is the debenture interest expense. It is not given. You can calculate it yourself. How? Here is some working for you to calculate the interest. You can see here at the bottom for you to calculate the interest. You can see that what I did is for the first 7 months, which is from 1st of October X5 until 30th of April X6. That was for 9 months, right? So that one should be for 7 months, should be multiplied by 5%, multiplied by 20,000, which is the balance brought down. So you take the balance BD, which is the balance brought down in your debenture account. And the second part is when you issue a new debenture. So when you issue new debenture, the newly issued debenture is 290,000. How do you get 290? You take out, you go and take the difference between 310, the closing balance with the opening balance, so 290 times 5%, and that was starting from 1st of May X6 up till 30th of September X6, the year, and that is 5 months. So you have 6042. I round it up to the nearest ringgit Malaysia. So it is 6625. So this is the amount that you incurred, debenture interest that you incurred. And since there are no debenture interest payable account given, So these are what that you actually paid as well. So what you actually paid is this, right? And this is also what you are, that one that you incurred, the one that you incurred, right? So the okay, so you can see here there are no opening balance or closing balance that was given related to the interest account or interest payable. So there you have 625. This one is an outflow. Oh, this is too dark the color, so why don't I just use a little better option. Okay, this one is better. Okay, outflow. So bank, you will have to include that under your operating activities right after cash generated from operation, but this one should be included in the adjustment for. You're going to include that because this is related to financing activities. You normally pay interest because that relates to financing activities, so you need to remove that non-operating item, which is your interest, right? And I'm using the same thing. See, sorry, it should be the voice. And at the bottom here is going to be the same, 625. Yeah, 625. We're almost done. Next is the simple one, which is all this. Should be able to do that. We're going to look at the changes in inventories, account receivable, revenue receivable, prepayments, and accounts payable. Remember the first four here is your operating asset. The last one is your operating liabilities. So let's see whether you get or not the increase in inventories. We start with the, so we have done this part already, right? We have not yet investigated general reserve, I know. We're going to look at inventory. So yes, there is an increase in inventories, 372,000 at the end. So it is 102. That 102,000 is the working capital changes that took place. And that working capital changes, I have some little reminder here for you, for those that have maybe forgotten the reason why. I explained in my previous video regarding what caused the changes. What caused the changes. But here at the moment, if there is a decrease, you need to add back. Yeah, but here it is an increase. So increase, you need to go and deduct. So I deduct the increase in inventory. So if you go and investigate further, so let's just go and do it. We have done this for our inventories. You may be wondering what is this red box all about. This is about the step that I was doing. I can reveal it for you. Yeah, that was the step that you need to do, and we are actually doing it. And the step 5. So we are now already in step 5. What is step 5? What is step 5? Step 5 is this, where you are trying to find out the cash flow from operating activities, and that is using the indirect method. So step 5 will start off with this item, which is to find out profit before tax. As we go along, we will find that. But now we're just doing we have done this part. We're now doing the adjustment for working capital. We are done already with step 5B, which is the adjustment for non-cash transaction and non-operating item. We are done with step 5C. We adjust the working capital changes. We are now doing it, sorry. So you can see that for your inventories here, yeah, the same thing here. You can see account receivable has increased by 70,000. So the effect is an increase you need to deduct. Same goes for your revenue receivable, which is your current asset. You should also deduct them because there was an increase. But for the prepayments, you can see there was a reduction or a decrease. So there were 3 increases in the accounts or in your operating asset with 1 decrease. So the effect should be similar. For the increase, you are going to deduct. Why do you deduct the increase in receivable, for example? Because you need to go and pay more to your customer. Maybe they delay in terms of the payment of that to your company, right? So that's why there are less cash being received, because they don't they hold their debt longer, right, than maybe the collection date. So increase in revenue receivable, the same thing. Decrease in prepayment, you are going to add. Why? Because you do not have to pay faster than before. You can see there was a reduction. And then increase in accounts payable. Increase in accounts payable is here, right? And there was an increase of 30,000, and I'm showing you actually the one for accounts payable, right? 20, 220 and 30. Next. You are done with that, right? So now you get your cash generated from operation 509,625. So this is the last thing that you need to do. Is this one actually you will get it later, because you need to first settle this. So we can do this profit before tax. So if you see here, profit before tax is not directly given as in our previous question. So when the profit before tax is not directly given, what you can do is you can make use of my suggestion here. You can, if it's not directly being provided, right, you can determine by reconciling the opening balances of retained profit with its closing balances. So go and set up the retained profits account and look at the difference of the account for you to derive at the profit before tax. So you should do the adjustment bottom up. Right? When I say bottom up means you should go and add back or go and do the reverse of the whatever things that you have done in your statement of profit or loss to arrive at the profit before tax. For example, you need to go and add back the income tax, the transfer out of profits that you have made to other reserve, maybe transfer to general reserve. Maybe you made earlier bonus issue out of profits, right? Those have to be also reflected in your accounts. Dividend expense, in this one means either interim or final dividend, so that has to be added back. Added means put back to the debit side. All this must be put on the debit side of your retained profit account. If there are any other expenses written off to the retained profit, premium on redemption, for example, or if there is any transfer that you made from the retained profit to the other reserve, transfer from other reserve to the retained profit, meaning that the one that you credit retained profit, the one that you debit the reserve account, right? Maybe things like transfer from general reserve back to the retained profit. That should be deducted. When I say deducted, means it should be put on the credit side. So I would suggest you to reconstruct. Oh, there was a spelling error here. Okay. Reconstruct the retained profit T account. So let's us do that together, which is going to be our step. We're doing our step 5A actually, find out the profit before tax. We are almost done with the 6th step. So how? Let's look at my accounts here. If you want to have a look on this, why not? Just give you some bonus answer for you. So earlier on, we have the retained profit being utilized for the bonus issue. And remember, these are bonus shares that are non-cash transactions. So I use blue, right? So I said. And you also have your dividend. And this dividend is your financing activity. So we go and put back those items that we earlier have adjusted. Remember, these are from the previous account here that you have, right? That you have done earlier. Okay, that one. And next is on this credit side, you have some information regarding some transfer to reserve that was indirectly given. Okay, that was a transfer to general reserve. How do I know? Yeah, let's check the information given. at the bottom here, nothing is informed. This is just giving you the information on cash and cash equivalent, right? Don't worry, you can check your general reserve. So the changes in general reserve here, if you can see, there was an increase 220,000. Yeah, sorry, where is it? Sorry, 560,000 down, and it was reduced to 310. So if that is not being informed, anything is not being informed, you would assume that the reduction of general reserve is due to the transfer made from general reserve back to the retained profit. So 250,000 is being debited to the general reserve and credited. I mean, credited means it is put on the credit side here, right? 250,000. So you can now total up this section, right, of your retained profit, and this should equal the credit total. And the item here, nothing is here, just reserve, right? So the balancing figure here would be taking 1680 minus all the debt credit entries here, credit entries. So you'll get the figure 610. This 610 will be now the figure that you have been looking for. So you can repeat that and pause that and watch that many times so that you can answer that, understand that better. And this one is going to be from here. Where is it? This one, 610,000. Your profit before tax. C. Sorry, I've already made it here, I think. Yes, 610. Now you can get the total here. The total here is coming from this total, and that should be purple as well. Now you get the total here, 303, right? 303. Okay. Then now you can add up with the total from investing, total from financing, add the three total, section 1, section 2, section 3. If you add up, you should get back 250,000, right? If you add up, you should get back 250,000. Let's say you do the working here, auto sum, this, plus up till here, up till from financing activities. And you get 250,000. It should be the same as the way you get through our cash and cash equivalent schedule. With that, you finish your preparation of statement of cash flow just by using the indirect method. And the last step is actually to do some checking. Actually, not really that difficult. The last step is for you to review all the transfer and review and make sure that you transfer all the amount. So in our case, we have not yet ticked this part. We need to go and adjust this, and everything now are being done. And we are now safe and sound with our cash flow. Everything has been checked, right? Every single item. Nothing should be missed here as well as here. Everything has been checked. So now after you have done that, complete the template. Yes, we did. And reconcile the total. Yes, we have reconciled, and we get back our total to be the same as net increase in cash and cash equivalent. With that, I thank you for watching. I'll see you when I will see you. Please do a lot of practice to get better each day, and every accounting is about doing more practice. With that, I thank you for watching. I'll see you when I will see you in our next video. Assalamualaikum warahmatullahi, and have a nice day ahead.